We're here.
I almost broke out into song.
You know,
Sam Cooke.
you know New York? Unique
You
New
can't say
York?
it slow.
It's like, you know New York, you need New York, you know you need unique New York. There you
Wait,
go.
one more time. One more time.
You know New York, you need New York, you know you need unique New York.
Okay. Okay, that was good.
There we go. There we go. So you got next on the next go round.
Oh Lord. You know I'm gonna say New York. Every time, New York.
How are you, Jolyn?
Me. Totally.
Ooh.
Totally. Totally. Just kidding.
All right. So now you got to do it now because guess what? We're live.
I can't do it.
We're still coming out of vacation mode, y'all. We're still coming out. We're 2 weeks removed. We're 2 weeks. Wait, 2 weeks? 1 week?
Just like,
2 weeks. She's getting the pitch together, y'all. We'll get it. We'll get it. All right. What's good, everybody? I am Mark Monroe, accompanied by my wonderful co-host, good friend, and on top of that, wonderful co-producer and co-creator, the awesome, the phenomenal, LL, the wonderful
jolyngc in the place to be. What does it, cousins?
And welcome to Your Come Up. This is a show in which a little bit of, we took some of the things of Trade Talk Tuesday, we took some of the good things of Hot Take Thursday, and we brought them all together so that way we can also give you some pretty phenomenal information. A show where we sometimes geek out on charts, and then on top of that, we discuss news, things that are coming down the pipeline, and how is it that you and your portfolio can be prepared so that we can build this generational wealth. So, if you haven't subscribed yet, go ahead and hit that subscribe button. It's somewhere down below. You'll probably even see that you'll get notified, and the screen will recognize you if you subscribe. And on top of that, if you like what we do, go ahead and just smash that like button, because then that way it opens it up, I guess, apparently in YouTube's algorithm, where people get to see us. Hopefully they're not shadow banning us. And then on top of that, if you want to be in the know, just like our good old cousin Draka in the building, who is #1 on the chat. Shout outs to Draka in the building. Then pretty much she had her notification bell on. So when you want to be in the know for when we have new content dropping, which there is content dropping. Oh, yes. You can be in the know. So without further ado, hey Jolyn.
What's up?
How do we do in these markets today?
How did I do, or how did y'all do? No, I'm just kidding.
Oh. I see what today's going to be.
It's hella green, y'all. I'm sorry. It's hella green. Okay. But that's coming off of a loss. But it's green now, so it's all good. All right. So we have the Dow that was down 192.38 points. S&P 500 was negative 26.19 points, and the Nasdaq was down a negative 96.05 points. The VIX was at 18.84 points, and the 10-year Treasury note was 1.354%. Heading over to sector performance, as you know, there are 11 sectors. We track the top 3 and the bottom 3 so we can see what the rotation is looking like. And you know what? Real estate was the only one that was green today, followed by utilities and health. And then for our bottom feeders, we got communication services, consumer discretionary, and energy. Heading over to our pick performance, y'all, we released a new list. It was, what was it, like 3 plates? Anyway, it's a whole meal over there. There's hella picks to choose from.
Hey.
So anyway, yeah, there's a lot. So we have the top 3, and you can find those on our Instagram at That Come Up Series. Just head on over there. It's one of the most recent posts, I believe. So go on ahead, find that post, and you can pick out your favorites and justify your favorites with your own research. All right, we got Zscaler coming in at #1, followed by FTNT Now, let me just say that Zscaler and FTNT both had 52-week highs. And then we have Taiwan Semiconductor coming in at number 3. Then for our bottom feeders, we got Snap, we got Hood, and we have Schrodinger. So those are the bottom 3. But Mark, we also had some other 52-week highs.
Of course.
STT.
Hey, Stay Street in the building. Hey, yep. the parents of the parents.
If you all know that XLK, all the XLK, XLY, all those ones, those are all a part of State Street. And State Street had a 52-week high. So what are these, the grandparents?
I mean, hey, which ones give out the better presents? Is it the grandparents or is it the actual parents?
I'm not going to say. So we got Google. We got Google as a 52-week high. And Datadog had a 52-week high. So that's a total of 5 52-week highs, y'all.
Huh.
Yeah. And Mark, just so you know, we have some questions that are ready to go straight off on Instagram. Y'all, if you have questions every Thursday, sometimes on a Wednesday, depends on what my workflow is looking like. But it's true. Like I, set things up. Okay. So if you all have questions for the Thursday show, and sometimes you can submit questions on the Tuesday too. It really just depends on what we're trying to cover. Sometimes we don't have as much time to cover it, but Thursday, for sure, your questions are of the utmost priority. So we have some questions coming in. They're all over different ticker symbols, all that. So get ready for that. And if you all have questions or you want to have your questions answered, when I have my story on Instagram, then you can reply to that story with your question. And I'll be sure to see it. If you DM it to me, I'm not going to see it. So it'll be lost in the sauce. So if you do it to the story, I always check the responses to those. So just so you know. So Mark, you got that. I know we have several charts to look up today, so
we can get a little bit of chart mastering in, a little bit. So just let me know how is it that you want to pull it off, and then on top of that, we got some stuff that our cousins got to be prepared for. So we have a full packed show. So
let's get a couple of questions. Just
let's do it.
All right, let me pull these questions up, y'all. Let me pull them up. And if you're just now submitting questions, I probably won't see it. FYI. All right, here goes a question from a cousin. Let's see. When should I use TBT? Since the market been hitting all-time highs, should I wait for a leap?
You could. But ultimately, I would say use TBT as more so a hedging mechanism, especially when we get closer towards things like economic numbers, like, for example, unemployment numbers, when the Fed speaks, depending on what the Fed says, CPI numbers, those types of things, because then they can cause treasury yields to spike. And as those things spike, then it ultimately gives you opportunities for like ETFs like TBT or plays like TBT to literally spike alongside with those treasuries. So if you kind of like get an idea of how is it that TBT moves alongside with treasuries, and then learning the behavior of treasuries and how is it that they respond economically, then you can use TBT as a sure thing hedge against your existing positions within your portfolio.
All right, here's another question from a cousin. Do you have any thoughts on Palantir and their analytics?
Oh, Palantir?
Mm-hmm.
I hear that it's pretty good. Personally, I've never used Palantir services, so, disclaimer, I don't use Palantir. I think most companies are still kind of like opening up to Palantir. I think that they use them more so for things that are very much so economic, or things that are more so on the macro level for data collection. I think that honestly that, they are definitely posing some significant, valuable tools in which the enterprise customers use alongside governmental. But I think that there's still some proof to be had, though, that I like what I see in the beginning for Palantir. I just want to see that same energy take place once we move out of COVID. Like, can they sustain that? They're picking up some significant steam as we're moving up out of the pandemic. But I just want to see that, okay, hey, is this a blip on the screen or is this here to stay?
Okay. Let's see. We have one more question before I think we should switch it up and get into some charts.
Okay.
I think it will, it's a market overall question. So the question is, where are we with market seasonality as we enter the fall?
Okay, so we're at the point of choppiness. We're essentially, when we say choppiness, it's because of the fact that there's not a lot of volume coming through. So it's kind of like we're grinding our way up to the top, and ultimately, are we at the point of getting to that exhaustion at the top of the mountain? And then essentially people kind of like take profit. And so that's where it's like, where you think about like a large profit taking period, that's what we know of as it pertains to corrections. And so when you see that happen, that's when you start to see high amounts of volume start to kick in. And that's really a sign that you're either going towards that most likely you're headed towards a correction. I think that where we're headed towards, though, is more so towards the backside of the year, where we start looking at more so, if you're looking at your portfolio, start focusing on things of, more like things that are impacted by holiday or things that do well during the Q3, Q4 season, though that we're already in Q3 now. But who does well during Q4, Q1? Who stands to benefit during those times? Those can set it up as beautiful entries for yourself, because a lot of the companies that will give you those beautiful entries, they've probably been beaten up now. So like when I was talking about, I think on Tuesday, when I was talking about Amazon, well, Amazon's one of those companies that starts to do well as we go towards the back end side of the year, because of the fact of, we have Black Friday, Christmas, and on top of that, some other things that take place during the holiday, whether it's, Hanukkah and, whatnot, and Kwanzaa. So I would just say, like, really look towards companies like that. Look at Apple, where Apple also starts to do very, very well because it's very cyclical. They announce something in either August or September, and then really it really goes through for the entire holiday season, where their sales really start to pick up, and then it slows down after the holiday season, going all the way through pretty much from the spring to the summer. So it's more so, like I said, look at the cyclical side of things, and from there, um, pick your positions accordingly, especially if you're thinking for the long term. I think the best thing, though, also in looking at that is also, if you're in a position, be sure that if you're picking out something, and when you come in, because let's say you come in during September, and then if you're playing 2 years out or 1 year out, whatever it is, you have to think about, like, okay, hey, well, 1 year away from today, well, most likely that's September of next year, or say, for example, sometime of next year, or say, for example, a 2 year position that's further out, then you have to think about when your exit is going to be. So that's another thing that where it gets a little bit tricky for investors as well. But I mean, typically around the time when you set up your rolling forward strategy, you're getting out around the time that right before the cyclical stock essentially gets weak, or the position gets weak.
Okay. So that's definitely something we should explore more in an upcoming episode.
We'll put a note on it.
Put a pin in that one. I'm making the note right now. All right, Mark. Okay, so remember how we said Zscaler and FTNT were in our top 3 for performance? Can we take a look at Zscaler?
Yes, we can. Let's look at Zscaler. We're gonna pretty much, let's see here. We're still getting used to our new system here, so we're going to open up our friend Zscaler and remove, say, for example, such image, and there we have it. So there's Zscaler on, say, for example, the chart. So that's it. When we showed you this, that's pretty much a year-to-date chart. But let's come over to our friend and look at it on a bigger screen, shall we? Give me 1 second. Need some real estate over here. Okay, so I'm going to switch us over to presentation mode. Okay, so here we have Zscaler. And essentially, looking at Zscaler, Zscaler over its period of time during the early part of the year, so around March, earnings weren't that great, but yet at the same token, there was a steady build going into, say, for example, Zscaler. So it didn't stay down for very long. Now, if I bring on our handy dandy technical tools, so currently right now I have, of course, buy and sell volume here. And then, of course, our candlestick charts here along with our three MAs. So as you can see, we are showing a strong bullish uptrend for the Zscaler stock. Think we need to probably be a little bit cautious here when it comes to Zscaler, because if you notice, we're trading very much so outside of the Bollinger Bands, which is letting you know that we've kind of like let this run a little far. So
Mm.
essentially, I wouldn't be surprised if this kind of like falls back. And interestingly, I'll run it as a comparison to, let's say, its counterpart, because they're both within the same space of, say, for example, cybersecurity. Then if you notice, they kind of trade alongside, very much so alike. So if I remove, say, for example, FTNT and just made it its own chart, as you can see,
Mhm.
FTNT is kind of traded a little bit differently, so to speak, but essentially still very much on the upside. Now, if I remove our handy dandy, no need to compare it against that. But if I look at it like this, we also see still a bullish uptrend for Fortinet as well. So both of them are showing strong signs of upside. I think the thing is also that's also propelling cybersecurity stocks is we just heard that the White House was having a summit on cybersecurity, given that we've seen a significant amount of hacks, go figure, since a lot of folks aren't at offices. So cybersecurity isn't able to be as managed when you have folks working as remotely. And I don't think that a lot of companies were very much so prepared for that. But I mean, so far they did, for the most part, a very good job. But at the same token, when you see companies like Microsoft being hit with SolarWinds attacks, or say, for example, even companies like Accenture, which, if you notice, they're also one of the newest additions on our list as well, taking some hits alongside within the cybersecurity. Those kind of like give you reason to pause, because you're talking about having access to tons of data, tons of client information, which can have significant impacts across as it pertains to the financial landscape. Now, one thing to keep in mind when we talk about Accenture, Accenture and Fortinet run kind of hand in hand together because of the fact that the two of them have a very strong strategical partnership. So if you notice the day that there was an announcement that Accenture had a significant data breach, or not really that significant, but a data breach, it definitely hit FTNT hard because of the fact that they are the cybersecurity provider of Accenture. So something to be mindful of when you start seeing hacks or things
Mhm.
that have breached cybersecurity walls of companies, then don't be surprised when these stocks tend to trade a little bit negative.
Okay, there was a question actually. So you already showed the FTNT chart. Do
Mm-hmm.
you right? I just want to make sure because there's a delay on this end. Um,
Yeah, so I briefly showed FTNT. So if you want me to, I could show you how it compares with Accenture.
mhm.
And so as you can see, when Accenture took a dip, they've been trading literally right alongside with each other. So, I mean, Accenture hasn't performed as well as, say, for example, FTNT, just as a heads up. But, I mean, looking at it, Accenture up 29%, FTNT up 113% year to date. So, just for perspective. But as you can see, when you kind of zoom out, you can kind of get a good idea that, okay, they kind of traded side by side until FTNT went on this glorious, magnificent run here, and then
Mhm.
kind of settled off. But I think that what we got to be mindful of, especially looking at this level for FTNT right here at the 310 level. This is very
Mhm.
much so a breakout level for FTNT. So we could be on the verge of seeing another breakout on FTNT.
Dang. Okay, so someone had a question. Why FTNT and not CrowdStrike?
Why FTNT and not CrowdStrike?
Mhm. As far as the picks for the list.
Well, I mean, here's my reasoning right here. Still new, still new, still
Mhm.
has to be proven. But for example, if I look at FTNT and look at it over a 5 year span, I mean, you're looking at something that has been proven over time. So it may not be one of the most sexiest names that's talked about the most, but yet at the same token, folks that work within tech or that understand cybersecurity, they know who FTNT is. CrowdStrike had a lot of emphasis coming through, And it's kind of interesting that, I look at it like this. A lot of companies that came through IPO during the pandemic, I'm a little
Mhm.
leery of. And keep in mind, I can't throw every company on the list. If that was the case, then the list would never end, and it would just be a never-ending scroll of images. Because there's a ton of great companies out there. But ultimately, I'm just still waiting on CrowdStrike to really just prove itself to the masses. I think that once we get to that point, then essentially I can kind of like crown them. But until then, I can't crown CrowdStrike yet.
Okay. Let's take a question. Here's a question. Speaking of, stuff that's in the future here. Question is Brother Jerome going to push us into an early correction on the S&P and Nasdaq?
It's possible. I mean, it's kind of like if I had a coin and if I flipped it, then that's pretty much where you're at. It's 50-50. And the reason being is because markets don't like to be spooked. They don't like uncertainty. And when they don't like uncertainty, then they start to price things in. Now, the question is the biggest question of the day is, what do we look like as it pertains to raise of rates? Because really the reason why you saw markets down had nothing to do with what was happening over there in Afghanistan, especially in Kabul, especially like, the bombings. And, I just definitely want to send thoughts and prayers out to those in whom which that have lost their lives during all of that. It seems like it's just like chaos. But I don't think that it had anything to do about that. One of the stories that nobody's really talking about is what's happening in South Korea, where they decided to raise rates by 0.25%, raising it up to about 0.75. So they're still not even at 1%. So they're at 0.75%. And so that kind of like got a little bit of attention and potentially spooked investors overnight, which sent markets across the globe into like, oh, well, if they're raising rates, is this like the thing in which that we start to see central banks start to make moves? Well, technically no, because you can journey back a little bit before South Korea raised its rates. You can see that EU or what's happening over there in Europe, they literally left their rates unchanged. So it's kind of like this thing where people are trying to figure out, okay, in this global economy, what's really happening? What's truly happening to supply chains and logistics? And on top of that, how is that affecting customers around, especially when we think about things like inflation? So those are all the things that I would say that are probably like the factors. And then going into Jackson Hole for the Fed, if the Fed decides to taper, I think the market has kind of like already started to price that in. I think it's a matter of if the Fed says no, they're not going to taper anytime soon, and they're still remaining on schedule, which I'm a firm believer that that's kind of like where we're headed. Then I think the market is going to consistently go on as business as usual and stick to its original programming. If there is anything that gives light, so which means that I think that the Fed is going to come through dovish and not hawkish, meaning that he's going to be more so in the lighter tone and not the stronger tone. I think that when we look at the Fed and Chairman Powell, I think the other part is if he does go that route, then I don't think that it's going to really trigger the correction because I think that we're still in a market of rolling corrections. And so when you're in rolling corrections, then you're seeing different things across different indexes and sectors pulling back, but you don't really see again the strong volume, and that would make me go back to the SPY, which I'll do in a little bit later, just to give everybody a glimpse of what that looks like. But yeah, you're not really seeing anything significant there that's telling us, okay, hey, there's look towards a correction.
Gotcha. All right. So moving on. Here's a question. VIX versus the Fear and Greed Index. Which does one prioritize when taking a trade?
I mean, if you're literally setting your trades just accordingly to the Fear and Greed Index, then I mean, that gives you reason to significantly pause. You should never really set your trades towards a Fear and Greed Index. It's a good indicator as it pertains to where are things going, or what the current consensus is, maybe. But for the most part, and not to say where things are going, I misspoke, but more so in the sense of what the current feeling is, what the current sentiment is. But more so especially if you're trading on long term, I mean, you got to be able to pick your entries and say, all right, well, hey, this is where my entry is, and find a good one. And you're more so looking at that based upon what, hey, are we at a level of overbought or oversold? Are we also at an area where are we in congruence to the 50-day, 200-day moving average? And also, what do the trends look like? Are we showing a bullish uptrend? Are we showing a bearish downtrend? Where are we at in the cycle of things? So, for example, are we in a cycle in which that this is typically an area where the stock or the current position that I'm looking to get into is weak, which can give me entry points? All those types of things. If you're looking at other things like, for example, something that they post on CNN, that's not going to really help you.
Okay, so take a moment to check the chat, right? The chat, not the YouTube chat, but the Zoom chat. And while you're doing that, the next question is.
Well, I can't check it, so.
Oh, okay. So, with the VIX, then, can we take a look at that?
Sure. Let me pull it up. Okay. So here's our wonderful friend, aka the VIX, the volatility index of the S&P 500. So of course there is no volume on the VIX. It's just pretty much an indicator of all things, and really the VIX gives you a good reading of where the options market is. A lot of folks don't really talk about that, but it kind of gives you an idea of where kind of like where we are in the grand scheme of things as it pertains to put to call ratios are. But okay, so let's take a quick look at the VIX. One thing to know is, and let me look at it a little bit further. So as you're starting to see, we're starting to see a little bit of an uptrend here, and this is what it represents on the 5-day, but we're still well below. And the interesting thing is, for the most part, when you look at the VIX, it typically stays below its 20-day or 21-day or 13-day, and also its 50-day exponential moving average. The only time when you see it really come up, so to speak, no pun intended, is when we see massive spikes. A lot of folks are getting a little bit spooked now because of the fact that we see the VIX around the 19 to 20 range. But really, where you really should be worried is, especially when we're in correction, is when we get to like the 23s and 24s. That's really where you're going to see where we're talking about corrections within the market, so to speak.
How do the rolling corrections play out on this chart?
So when looking at rolling corrections, you see it's kind of like a rolling hill where you see that, and I'll compare it against something just so that way you can kind of get a good look at it. Let's look at the SPY ETF. And so as you can see here, we dip, and then here it's kind of like these are kind of like the small little pullbacks here and there. Small blips on the screen. So those produce like small little arenas. Now, if I go even further to show you something, let's remove the SPY and then let's look at Apple. Because I firmly believe that Apple is kind of going to dictate exactly where this market goes and moving forward. So let's see here. If I'm looking at Apple, as you can see, it can definitely show you where those swells are, and especially given that the VIX is a representation of the S&P 500. So anytime when you have your high, say for example, your high beta stocks or your higher weighting stocks like Apple, Microsoft, and Facebook, Google, those types of companies, when they start to take hits in the market, then that's when you really start to see the VIX really start to spike. Because they create dislinks in the chain. So here we are. We see that in days in which the Apple can have a strong pullback from here. That's where you kind of see that you see those large spikes, and that's how it's represented. Now, in some cases, like for example, we see that the VIX spiked here, but yet at the same token, Apple was still on the uptrend. We also see here in which that Apple was still again on the uptrend, and then of course we saw that the VIX was dying down, though that Apple was dipping down. And so it's kind of like you have to look at a multitude of probably I would say give it the top 5 companies, the top 5 weighted companies within the S&P 500, and then just run that in reference to the volatility index, and it'll give you a good read. But I strongly believe that since we're now in this is like Apple's time of the year, and especially if I switch over charts for a hot second and come back to Apple, you kind of get the glimpse that, okay, hey, we're at this point where we're at levels, and essentially it's been struggling to break 151. If it can break 151, then the next level for Apple is definitely going to be at the 156. And then at that point in time, I think that Apple is definitely going to go for its correction. I think that, and don't look at the August 30th, it's probably going to be somewhere here in between time of its release of its event. And then from there, I think that Apple's definitely going to take its dip. And the thing about corrections for folks to understand, just so that we're clear, Apple, especially if we're going from, say, for example, from May 24th, where we're at the bottom, and then coming all the way up to the top here, we're pretty much at the high levels of here in August. Pretty much, again, this was a lot of sentiment coming into Apple in the sense of, okay, hey, they did well. Then this was their earnings, in which I was kind of like, okay. And then now it's like we're starting to see some of that we're starting to see some of the seller volume. But again, nothing to the high side like we're accustomed to, where it's like, if we think about it, if you draw a horizontal line on your trading view and literally just place it where you see those areas of large dips, then that can kind of like be a good placement for you, because then you can see on January 25th of 2021, you can see the same thing on, say, for example, August 31st. After the stock split, the stock sold off, and yet these were high levels of volume, and anytime when it reaches that point, so for example, when you start seeing large volumes of, like, at this time this was 716 million, and then you can set another marker, another horizontal line, to say that, okay, hey, if it gets above its typical bullish buyer's volume, then that's also a way that you could say that, okay, hey, we could possibly be seeing Apple go for a pullback. So anything within this range of, really the 363 to about 700 or 700 million shares that are traded, that can kind of spell, say, for example, the sell-off within Apple. And then, of course, use the buy-sell volume so that way you can get a good idea of what the ratio was between sellers and those in whom which they were buying. Because when you see 716 million, somebody would say, okay, hey, 716 million people sold. No, that is not true. It's technically probably what you're seeing is about there's somewhere of a divided line between the folks that have bought and the folks in whom which that have sold.
Okay, so there's some questions about beta. If you can go more into like what beta is and how we use it when we're trading.
Oh, that's definitely going to be for another day.
Okay, so in the meantime, y'all, you can just head on over to Investopedia and look up the basic definition, and then we will dig deeper into it.
Yeah, so when we do talk about high beta stocks, like those are pretty much known as your growth stocks. They move a lot more. There's a lot more dollar movement that's taking place, whether to the upside or to the downside, versus your typical stocks that are typically like high beta stocks are always going to be considered growth stocks. Low beta stocks are going to be looked at as, say, for example, your value-based stocks. Not a lot of movement, strong dividend, and then ultimately from there, you're not going to see so much swings between the upside and the downside, or the upside to the upside again. So, for example, a company that is a high beta stock would be like a Amazon, a Netflix, a Tesla, a Shopify. Those are all high beta stocks. Non-high beta stock, and you can kind of say it like Apple isn't really a high beta stock.
No, if you watch it, Lord have mercy.
Apple is not a high beta stock. Microsoft, it's kind of like been trading somewhat kind of like as a high beta, but it's kind of like a hybrid between high beta and low, because of the fact that it doesn't really move as much as everybody else thinks it is. It's just that we're in a totally different landscape. So it means that essentially that you could throw all the trends out from years before, if we're starting to see that those trends are changing, and now Microsoft has become now a growth stock. Because whereas once before, Apple or Microsoft didn't really quote unquote move, like say for example your other stocks, but yet at the same token it still produced value year over year over year. So, and that's what I'm saying. It's like if you look at it like a Pepsi or say for example an AT&T, there is nothing high beta about any of those stocks. But at the same token, what you trade off in the high beta movement is kind of like AT&T probably gives you the strongest dividend. So
okay, so we definitely have questions related to what to expect for tomorrow with Jerome and friends.
Okay.
So there are can I talk? Can I talk? Oh my gosh. Hella tongue twisted over here. There were some questions. What'd you say?
Unique New
Oh,
York.
no, don't even. Okay, so basically the questions are what to expect tomorrow. What should we be listening out for?
Well, I mean, the thing that everybody's going to be listening out for is the Fed going to taper starting in October or in September? I don't think that it's going to happen in September. I think that we'll probably get the announcement in October, and then maybe the tapering starts in maybe November or December, if at the earliest. But a lot of folks are still pulling for January, February for the Fed to start tapering. And here's the thing to look at. Go back and look at, I think it's, trying to think off at the top of my head. Go back and look at 2013 and I think 2014, where there was also a tapering moment there. Didn't affect stocks at all. Now, of course, a lot of folks got quote unquote spooked because of the fact of what they were hearing significantly all the time in the media. But then after a while, it's like, oh, well, there's nothing to fear. There's really no boogeyman in the closet. It's more so just your dirty clothes just sitting in the hamper, just propped up, and you need to go wash your clothes. So I think that's what we need to look at in moving forward. I think that also it's like, look at what he says as it pertains to job growth and GDP. I mean, we did see a good GDP number, though that essentially it's still, I mean, it's a good number, but yet at the same token, the question is, with a lot of the economic indicators and data, is how much is it missing? Like, for example, you could poke holes in the unemployment numbers, and people can just say, well, the unemployment rate is starting to go lower. But is that because of the fact that the unemployment rate is so low because maybe people stop applying, or maybe folks they were diagnosed with COVID, they became hospitalized, with some type of ailment, or maybe even COVID, or they just gave up. They just gave up on the entire process as it pertains to applying and going through that process, or they may have found a temporary job where they're working as, say, for example, a gig worker in the gig economy. So there's so many things that you can look at and then say that, okay, hey, well, how many folks within the United States are underemployed, which means that they're employed, but their wages don't reflect exactly what they should be making. So there's a lot of economic indicators there in which that is like, it's not an end all be all number when we just look at, okay, hey, unemployment, which is a huge number in which that the Fed kind of like follows, but they look at some of the things underneath it, the finer details, the fine print, to say, okay, hey, well, we see that these unemployment numbers are down, but I mean, what's happening in, say, for example, Black and Hispanic and Latino communities and populations? They're still underemployed, if not their unemployment rates are still high. So he's looking at that and saying, all right, well, we can still see, that there's still more room for improvement. Another thing that he can look at is, say, for example, wage growth. Are we seeing wages increase, given in the sense that we see that there's a certain inflation happening? No, we don't. So we see a lot of job openings, but how many of those jobs are being filled? So a lot of those things come into play when we think about, like, okay, hey, well, what's this mandate for the Fed to really start to taper? What does it look like for folks when it comes to paying their rent? Like, when we start doing all those things and we start adding in all those data points, the economy doesn't look as, say, for example, rosy as everybody says that it is, or that it's roaring back as they expect it to be. It's going to come back. It's just going to take time, and I think that's the biggest thing. And he's going to weather he's going to weather everybody's expectations. I don't think that he's going to come out as hawkish as everybody thinks that he is, because I think a lot of folks are looking at the July meeting notes, but a lot can
Mm,
happen because the July meeting notes were a reflection from June. A lot has
mm-hmm.
happened since June, and now that we're in August, and then on top of that, things have taken place in July. If we're going off of that logic, well, we saw significant spikes within COVID, not only just vaccinations but also diagnoses of people catching COVID. And so, what does that say about the numbers? How does that affect, say, for example, decision making? So that's why I said it's like at this point in time, you got to look at it in the sense of, okay, well, where are we? Where are we really?
How do you think the recent swell of mandates for when it comes to vaccinations are going to impact the just going forward?
I think that that's going to be huge. I mean, I think that ultimately, and if I get the chance, I'll probably show like a chart where it shows you globally and where some of the top countries in the world, where are they as it pertains to being fully vaccinated?
Mm-hmm.
Um, because the thing is like you want to find you want people to essentially become more vaccinated, so that way essentially it's like you can kind of get ahead of any potential new spreads as it pertains to variants, which makes it a little bit more controllable. When that's not the case, then it makes it a little bit more difficult, and then thus it hurts economic numbers. Hence the reason why when you can't get under control of things, it forces companies to say, okay, hey, well, now we have to scale back our reopening as it pertains to employees coming back to the office. You're starting to see tech companies and other companies saying, okay, hey, we're not reopening our offices until January of 2022. And then on top of that, you also see companies mandating that, okay, hey, if you're going to be at the office, especially making it a safe environment for everybody else, because you never know who has, say, for example, a compromised immune system.
Mm.
You have to make it a safe environment, because if not, I mean, imagine what that liability insurance looks like for companies, especially if somebody happens to catch COVID and then they become hospitalized and it causes damage. Okay, now who's liable? Is it the employee who's liable, and whom which that they potentially can trace it back to that they caught it from, or is it the company that's liable? And if the company is liable, then what happens to the employee that ultimately happened to expose people to COVID? You see how that starts to become a slippery slope? And so just doing that kind of dance, it's just like, all right, well, what's the easiest road possible? Mandate.
Well, I don't even want to get too political on that, so we're gonna leave that there
Oh,
as
I
a
was
result.
I was literally just talking about
Yeah, I'm
companies.
just saying like that when you were talking about that, like all these other points were coming up, and so moving on.
it's,
Moving
it's all
on.
it's all it's all about risk mitigation. It's all about risk mitigation. It's like what makes
It's
companies
all about risk
successful.
mitigation plus economics, though.
That is very much
Like
so true.
honestly, it's about the money. Like let's
Very
not
much so true.
even. It's about the money. Like
Yep.
it's not about our health. It's definitely about the money. Okay, so there was another. Well, let's see. We have 15 minutes, so I definitely wanted to take a look at the SPY. There was something that you mentioned last time, not the patterns of the month, but the other thing that you wanted to show.
Yes.
Yeah. So we could spend some time on that, and then
Let's do it.
the challenge.
Okay, this is gonna be kind of challenging, especially since. Okay, well, I'll see what I can do. Let's see here. I'm gonna remove some things on my end. Give me one quick second. Okay.
Not necessarily a new challenge, but just addressing the challenge that was already had.
Oh, that's fair.
Yeah.
Okay. Let's go into presentation mode and let's look at.
The SPY, right?
Yep, we're looking at the SPY. Now, something to keep in mind is like, especially like the SPY kind of like gives you a good glimpse of things, and notice how things typically work like clockwork. So, and here's one of the things that why I alluded to. There's no such thing as like kind of like magic or being able to show things. It's just more so in the sense of just paying attention. So on this day, we see that the SPY typically, which is the ETF of the S&P 500, pays out a dividend. Now, of course, the screen is a little small. Keep in mind I use a 49-inch monitor, so the resolution is a little weird, but please bear with me. Hopefully you all can see it. So essentially we have from September 18th to December 18th of 2020, we have, say, for example, a dividend here, a dividend here. Okay, we also have the same thing take place here to, say, for example, March 19th. Starting to notice a trend here. Then we also have, say, for example, from March 19th to, say, for example, June 18th of 2021. And then we also have from June, and if you think about it, 91 days, 91 days, 91 days. So if we go from June 18th to, say, for example, the next 91 days, that places us exactly at September 17th of 2021. So we go from, again, September 18th of 2020 to December 18th of 2020. Notice these things are all quadruple witching periods. They're all quadruple witching periods. Now, I'm going to just go to the year-to-date chart so that way you guys can get an idea of what is it that I'm talking about. So if I bring this, I'm going to bring this handy-dandy indicator up here so that way I don't lose it. And
remind me of the question about indicators.
Yep.
Don't let me forget.
Sure. So if you think about it, on the day that we literally had a dividend, then essentially the market was red. The S&P 500 was red. And if we look back to, say, for example, March 19th, the market was red. Now, here's a little thing for everybody in which that does dividends. Well, on days in which that dividends are being paid out, the dividends are normally issued before the market is open, for the most part. And then essentially you typically see a sell-off of folks in whom which that now have collected their dividend. It normally triggers a sell-off because now they want to also take profit, especially if the stock or the position itself was moving. So if you look at that, like, think about it. We've had on numerous occasions where we've seen a quadruple witching period, we saw that, okay, hey, that there was movement. Now, I want you to think about something else because this is 91 days. Now we're going to do some other chart metrics here. If you think about it here, we go from this moment to, say, for example, this moment. This is 31 days. And then when we go from this moment to this moment, we'll say that's another 31 days. So you're starting to notice a trend here where every 31 days we kind of reach the S&P 500 has kind of like reached its bottom. Sorry, despicable of me. So essentially what we see is that the market typically takes a dip. Now, here's another interesting thing that we notice. Now that I'm drawing these indicators for y'all, think about it. We reach a high point, and essentially before the 18th or the 19th of every month, we typically go, it's pretty much 3 days before. So if you subtract the 3 days before and essentially look at it from when's the next time that we should be pulling back. So if you have 31 days till the next pullback, and if we take the same type of indicator and we're going to just copy it, and then we're going to move this one to here. So we should probably be seeing it around the week of September, really September 22nd or more so, like pretty much between quadruple witching and September 22nd. Now, if we move back, say, for example, 3 days. So if we come back by 3 days, so 1, 2, well, I guess it puts us back by 5 because there's a week in there. So that puts us exactly on September 17th even. So it kind of gives you an idea of when is it that you should probably be looking for the exit, or when is it that you should probably be looking for your puts to essentially hedge against your own positions. And that's a good marker. So essentially what you can say is that we could probably be topping out the week of September 10th. And then after the week of September 10th, so for example, that would place the SPY at, say, for example, 451, 452. And then essentially from there, we kind of get into no man's land, and ultimately the market needs a correction from this point in time. Because notice we're down here at 446 at the close, so of course it's going to give us a few days to come back up. Of course, the Fed and doing their business as it pertains to folks being spooked by the market. We're going to trade a little bit choppy. I could be a little bit wrong as it pertains to what we're seeing. So we could say 451 or 455. just to give you a range. But either way, 9 times out of 10, you're going to see the market pull back down to its 50-day moving average. And again, you're going to start seeing rolling corrections. Now, is it all doom and gloom? No. And the reason why we say it's not all doom and gloom, because some companies have already been corrected and they're coming out of correction. It's just a matter of who is going to be those companies that ultimately correct, that cause significant movement and pull in, say, for example, the S&P 500 or across other index or exchanges. And that's one of the things to take into consideration.
Nice. Oh, so the question that a cousin had that I wanted to make sure got answered was, what indicators complement Fibonacci retracement?
Things that I mean, it's a matter of what your combination is, but some of the things that you can use is you can use a stochastic on there. And stochastic, what it does is it's a very good indicator on both the fast and the slow. It gives you both. And what it does is it takes, say, for example, the previous close, and then alongside with either the 5-day or the 14-day average as it pertains to, price. And then essentially it kind of like sets it up. So you can probably run that in your indicators on TradingView or other places. You can run stochastic alongside with Fibonacci, along with, say, for example, using the good old faithful, which is your Bollinger Bands, which you can see, okay, hey, where is it that we're seeing a top, and where is it that we know that we're going to have to pull back because of the fact that we've gotten a little bit too hot. And then on top of that, if you want to just top it off with maybe either using a stochastic RSI or just use a basic RSI to let you know, hey, are we oversold or overbought?
Boom. All right. So great. Okay. So I'm looking at these. A lot of these questions are the dupes. It's looking like we've answered. Oh wait, no, there's one question that we didn't. Here it goes. Will TCL removing Roku from its TVs hurt Roku long term?
Say that one more time.
Will TCL removing Roku from its TVs hurt Roku long term?
I don't think so. I mean, Roku can find another partner. There's Vizio. There's Sharp, which, I mean, honestly, who really buys those? And then on top of that, Roku's already significantly embedded. They sell their own devices that can match up with any TV platform. So I don't see any issues there. I think that gives a good argument towards Google and the battle between Google and Roku, especially when we had that conversation way back talking about Roku versus YouTube TV Google. But outside of that, I don't really see any issues with Roku and TCL. Kind of like if that's what it is, I don't see any issue there. I think that, like, really, if we ask what's TCL's claim to fame, unless they're looking to go partner with, Google like Sony has, or maybe even look at another partner, but who would that be? You're not going to do Tizen, so because that's all Samsung proprietary, and you're not going to do LG because those companies, they work on their own. Sony's with Google. You could probably try Apple, but then would that really make sense either? Especially since Apple makes a better killing with their Apple devices. So I don't see any issues there for Roku.
Okay. Well, Mark, we have 5 minutes left.
Wow.
We covered, we did. So the charts today that were covered, we went over Zscaler, we went over SPY, we looked at FTNT. Those are the main ones.
Okay.
Now for the answer to the chart, most people got it, but let's put it on the record.
Okay, so let me pull it up for everybody. So if we're looking at a chart year to date, and we'll just remove all these other indicators alongside, and the stock was, can we get a drum roll, please? It was XOK. The technology ETF fund was the hidden stock. Was the stock for the stock challenge. So if you got it, congratulations. If you didn't,
Mhm.
that's okay. There's always more room for improvement. We heard some folks like having different types of stock tickers, and it's okay. I mean, the goal is just that you just start getting used to seeing things, and you start developing that muscle memory. Um, and so
When's the next game, Mark,
I
or the
think the
next
next,
challenge?
I don't know. I mean, just be advised. It's like I will start being more active, a little bit more on social media, so you will start seeing us post there. We may can start trying some YouTube shorts, by the way, where we start showing some content there. But for the most part, just look towards Instagram or Twitter. Um, and I posted one on Twitter, and that one was Twilio.
Okay, so congratulations to those of you who got those ones right. And yeah, so now be on the lookout for another one or two coming your way.
Indeed.
All right. Okay, so I think we got through all of the questions. Some of them are questions that will need to be for the next time because it's related to a chart that we haven't gone over yet. And so I don't want just like a bare question out there when we can really dig deep. So that's all. Do you have any closing words for the weekend?
Outside of having a great weekend and getting some rest, just continue to keep studying up. I mean, there's a lot of tickers that are on those plates, so to speak, depending on what your risk appetite is. I would say this for everybody, if you want to be good at something, especially in this arena, start small. You don't have to master everything. I mean, would you rather be the jack of all trades or the king of a craft or queen of a craft? And so, in order to be the king or queen of a craft, I mean, pretty much start small, master those, get to know those stocks like the back of your hand, get to know the company, their financials, and also maybe even learn an index, just one index. Just start there. From there, it's like it gives you good information and insight where you can say, okay, hey, I start to understand exactly their trends based upon news in which I hear, based upon financial information. Where is it that the company is going? Getting a good projection of what the company is doing, or getting a good idea of what the competition looks like from their landscape and how does it affect such company. How do the economics impact such companies or index? I would say just start off with your starting five. So just look at your hand and say, okay, hey, if I had to go with my five, who would I pick? And I would say pick 4 rock stars and then have one company in there that challenges you. And then from there, pick one index. So you either have the Russell or you have the S&P 500. You can do some international like the FTSE, or say, for example, the Hong Kong Sang, or say, for example, the Japanese Nikkei. You can do any of those. But essentially, just starting off, if you want to start off on the domestic home front, just start off with the S&P 500 and just kind of getting a gauge as it pertains to its behavior, and really how does the economics and current landscape of things, how has it impacted that index. That's a good way to start. And once when you start feeling like, okay, hey, I've got it, and you started testing your knowledge, and your knowledge has come back with validation, because when you execute, the validation comes, it will start to follow. It'll either validate you to let you know that you were spot on, or maybe that you got a few things and you missed it, or that you were just completely off the mark, and that's okay. Just go back to the drawing board and retool and reshape your thesis. So I think that that's where everybody should start versus trying to master everything on the chart, because then you can get so locked into it. But they're good watch lists. So hopefully you put it together in your watch list, and you can arrange it however you decide to. But it's a good watch list for you to be able to see exactly like, okay, hey, this is kind of like how the market flourishes. And one of the things that I do is sometimes I put companies in there just to be a cross reference, though that they're good companies, but just as good cross reference towards other companies. Sometimes they can be defensive from other companies. It gives you a little something something. So that way, just in case if you find yourself in a situation, you can technically pick certain stocks within the pick list of the come up series. And while, let's say, for example, the market is correcting, one of them can be very much so defensive for you. So that way you still have captured a bull market somewhere. So something to be mindful of.
Yeah, I'm glad you said that, because also another thing that I'm seeing out here in these investing streets is, people out there just trying to be, like a guru when it comes to stocks and all that. And let me tell you something, okay? Like, you can legit mind your business and be on your P's and Q's, working, moving like a ninja silently and getting your money. Like, you don't feel the pressure to, have to orient your whole entire social media or whatever to talking about stocks or analyzing them or like whatever. You can literally just be heads down with pencil, paper, whatever, learning. And your parents, as in XOK, XOY, Stock Bay, SMH, pick a scale bay, pick a stock crush, whatever you want to do, and have those working for you while you are learning the market. And with those, you can say W2 who, like, straight up.
Just gotta say
and
consistent.
then and then if you want to, be out there, doing a little something
And hella traffic.
In traffic, maybe not even hella traffic, yet just a little bit of traffic, go for it. But there's something to be said about just, learning. So
I will say this. I'd be remiss if I didn't send this as a special shout out. I wanted to send a special shout out to our brother, the historian, Brian, his son, Ansar. Happy birthday, young man. Happy birthday, young king. Many, many more. We love you from the Come Up series. So here's to many more years. Congratulations, young fellow. I hope you had a good time skydiving or indoor skydiving. So, I mean, he's out here. I mean, if you ask this kid about like the planets and space, he's on it. So, yeah.
Ansar, he's so sweet. Like, whenever he gets off a call with you, he goes, "Okay, bye, love you." It's so precious. If we're doing birthday shout outs, let me shout out happy birthday to Anderson, my little nephew Anderson, and happy birthday to my niece Naraya. Her birthday is on Sunday, so.
Oh, and happy birthday to my big brother Diamond.
Hey,
his birthday was yesterday.
Birthday.
Yeah, his birthday was yesterday, so happy birthday, big bro.
Alrighty. Okay.
And yes, that is his actual name, Diamond.
Diamond. All right. Well, it's 4 minutes after, so.
All right. Well, on that note, until next time, I am Mark Monroe.
I'm jolyngc, the place to be.
And this has been Your Come Up. We will see you next week. Have a great weekend. Keep learning, keep researching. The more you learn, the more you earn, and be kind.